Okay, let's get going. So, busy morning. We've got a news as normal from me, and then we're going to be talking to three leading income managers. So, Thomas Moore from Aberdeen Equity Income, David Moss from CT UK High Income, and Ben Green from Supermarket Income REIT. And then at 12 o'clock just thereafter, I'm going to be announcing the winners of our QuotedData Investors' Choice Awards. So news first, a couple of battery funds in Caledonia, should be quick. How many energy income first? So not a very big fund, not very old fund, went wrong quite quickly, all kind of linked initially to rising interest rates, but also to a problem that the batteries funds had in terms of earning money from the national grid. Went down to a very big discount, and then they've been saying they've been trying to do something about their discount since, and they've decided to try and sell the fund. So, in what they announced this morning was that they've written down the NAV from 94, almost 95p down to about 85, 88 and a half. And that mostly that's down to them increasing the rate that they discount their full forecast cash flows at by 25 basis points, so 0.25%. But they've also lowered their revenue assumptions as well. So that all drags the NAV down. They are now fully operational. So they had this portfolio of things under construction. All these things are now being energized. And they do seem to be doing reasonably well in terms of revenue. So about getting off £68,000 a megawatt a year, so annualized, based on what they're earning in November. Obviously, this is very seasonal. It depends when the wind's blowing, the sun's shining, all that sort of thing. But that's not too bad, actually, if they can sustain that, but that's probably not sustainable. Anyway, they are still trying to sell a portfolio. They're quite a long way down the line with this. They've got a short list of bidders that are doing detailed due diligence. The whole thing's been pushed back by about a month, but they do expect to be able to announce a bid in December and to sign in January 2025. Now, that's all quite encouraging, really, especially when you think this thing's still on a 40% discount. So that's a 40% discount to the written down NAV based on today's share price. Now, whether they'll get NAV for it or not, I don't know, but it does feel to me like the share price might be a bit too low at the moment. Gresham House, bit more advanced along the way, has had the operational batteries for much longer, trading at a much wider discount, 54%. No dividends because of, obviously for no income or not enough income to pay a dividend. So what they want to do is to try and prove that their NAV is about right by selling some stuff. So they are looking to sell an equity stake in a 50 megawatt battery project that they've got called Glastonbury, and at the same time raise a bit of more money that they can use to upgrade that project to 4-hour batteries, and also take some of that cash and reduce their debt pile. Now, the debt's not enormous, so they're saying that's going to peak at about 20% of gross asset value, so that's normal gearing of about 25%, but they are looking to refinance it. And I think the issue is that the lenders are looking at the projected revenue and saying, can we really rely on that to pay the interest and get our money back? And so therefore, there's thinking we need quite a lot of coverage on this before, a lot of headroom before we'll lend you the money. Once they have refinanced the debt, though, they will reinstate dividends, and that's obviously going to be very good news for shareholders. So what they're leaning towards is paying what it says a sustainable dividend, so fully covered, of 3 small interims and then a larger final. And they've kind of hinted towards, I think, about 4p to 6p. So it was 7p a year, and they were hoping to grow that. But if they wanted to be fully covered, they want to be covered by cash flow. They're saying cash flow per share is going to be about sort of 4.5p up to about 6.2p next year. It's about 45 million of EBITDA up to about 55 million. They can be fairly sure about getting that because they've already got a big chunk of it contracted. Remember, they did that deal. And then they want to grow the earnings beyond that. So there are things that they're saying this morning that they can do, that they think they can grow the income really quite substantially. Now, the interesting thing here, I thought, was that they're assuming that they're only going to get, on average, about £45,000 per year per megawatt, which is a long way short of that 67,800 that Harmony are earning. So again, it feels to me like we are near the bottom of this one, but it's not as sort of certain an outcome as it would be if Harmony selling the portfolio. Finally, Caledonia, another one on a big discount, completely unjustified in this case. The family, the Kaysers that founded the trust at the beginning, their percentage ownership has been creeping up. And from the takeover co point of view, they form a concert party. So they own 49.49% of the voting rights of the shares now. And when you get over 30%, you can trigger a mandatory bid if you increase your stake. And the only way you can avoid doing that is to get permission from shareholders to say, if I up my stake, then I don't have to make a bid. And that's called a Rule 9 waiver. So they do this every year. They vote it on in the AGM, and it just lets the stake creep up and up towards 49.9, but it can't go through 49.9. So what they're having to do, because they're almost at that limit now, is convene a special meeting to ask the independent shareholders to approve buybacks that would take the concert party through 50% without triggering a bid. I think that's quite a straightforward thing, really. I can't imagine that people would be opposed to doing that. They do need to do buybacks to help control the discount a bit. They're asking permission to buy back up to 5% of the share capital. They bought quite a lot of shares back over the last 6 months. And so they just want to carry on doing that. The concert party won't vote on this because obviously they're completely conflicted. But I would be surprised if the independent shareholders didn't say yes. And if you are a shareholder, please do vote. So that is enough from me.